Investors breathe a sigh of relief today as we're seeing smaller market moves to close out the session. The major averages finishing the day mixed, with tech stocks outperforming. Joining us now is Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist of America. Gargi, good to see you.
Hi, it's great to be here.
So plenty of worries for investors right now. You got Trump tariffs and government firings, and folks are wondering, could the economy slow? Maybe it'll even tilt into a recession. We've seen this sell-off, but you're telling your clients, you know what, you need to stay overweight U.S. equities here. How come?
Yeah, so we are talking about staying overweight U.S. equities, but where is really important. So we are talking about some of the large caps and the quality parts of the market. We've obviously, as you pointed out, Josh, correctly, there's been a wall of worries. But I think anyone that's expecting a recession, I think it's a little bit too, that fear of recession at this juncture is a little bit too early. We just haven't seen that in the data that we've gotten so far. So yes, a slowdown, but yet we have to remember where the strength still is underpinning in the economy. And this is a services economy that is still growing at a little bit lower than 2%, but nowhere near the zero. So for now, quality parts of the market, we're telling investors to stay to tickers like QUAL, which gives you that sector neutral approach to quality companies that have that strong cash flow.
We have talked to a lot of investors right now who, are looking globally on a relative basis and saying, okay, the US might be fine, but Europe maybe has more upside down. We've already seen that, catch a bid. China might have more upside right now. How are you thinking about some of those
Absolutely.
issues?
So that's been the big story of this year. I mean, outside of the pullback that we've had this month, the big story has been the outperformance of the rest of the world. And this is why, frankly, we tell investors to build this diversified portfolio. Even when we wrote our year ahead outlook, which came out in January, we talked a lot about this exceptionalism in the US, which doesn't just mean US stocks. It just means focusing on the AI story. It means focusing on earnings growth, which of course is still, even to this day, coming largely from large cap US, but looking at corners of, again, international quality, international dividend, and doing so, especially now, given the rally that we've seen, with active management, really looking at those stock pickers that can look at certain parts of defensives in Germany and so on.
We got that CPI print this morning, right? Cooler than expected. I think investors sort of breathe kind of a collective sigh of relief there.
Yeah.
What did you make of that print, and what do you think the Fed made of it?
Yeah, so a couple of things that I was thinking about. The first one was just a reassurance for the market that January was a one-off, that this wasn't a reacceleration of inflation. The second thing that I took away was, especially as it pertains to the Fed, they've talked a lot about that core X shelter component or core services X housing component. And that softened from a very strong print in January to a 0.2 in February. And I think they'll be very reassured by that. Also, when we look at just the services component, that's coming down to a trend like 0.3 as opposed to the 0.5. So a couple of things there that I think the Fed and investors alike are going to be quite happy about. But I do still want to caution that inflation is still sticky. We're still at core 3.1%, headline 2.8. This is still a very sticky inflation regime. And we're telling investors, actually, inflation-linked bonds, especially in the front end of the curve, something like an STIP that gives you that very front-end real rate exposure, makes a lot of sense in your portfolios for the next couple of months.
Gargi, it's very interesting, the disconnect. We've been talking to a lot of strategists who say, stay calm in this environment. It doesn't feel calm when you look at the market. Now, on a day like today, fine, but even on a day like today, there's a lot of volatility. It doesn't feel calm when you watch the tariff headlines. So how do you talk to clients and square that?
Julie, you're so right. Obviously, it's one thing to be able to sit and say, stay calm, but it's quite different when you see a 10% drawdown. So what I am telling clients, and we're having a lot of these conversations right now, is this isn't a time to run to cash. This is a time to think about adding diversifiers and hedges. And there is a difference. Don't leave the market, don't sell the low. I mean, obviously, if everyone could always pick the low, we'd all be billionaires by now. But really add some hedges. And what might those hedges be? Think about assets that have been a little bit uncorrelated. So thinking about things like gold, that has been a wonderful hedge in portfolios. Thinking about just income generating products, that are getting you 6.5% 1.5% income in a portfolio. Things like adding to some inflation-protected bonds that we just talked about. Illiquid alternatives, another way in which you can sort of look at long-short positions that you're just looking at alpha generation instead of market beta. So really, and then we talked about international as well, looking at quality at the center of a portfolio. So add hedges. Don't run to cash, and I want to re-underwrite the idea that we're not really worried about a recession yet. So if there was a concern around recession, I think the conversation that we would be having would be a little bit different. Right now, I think this is just a pullback from some of the price to perfection that we had in the beginning of the year coming into this year, and this is a healthy pullback.
The dollar has been weakening. I'm just curious, final question. How should investors be thinking through that dynamic?
Yeah, look, mostly in the U.S. investors have a lot of home bias. I think now with the recent weakening of the dollar, I think one of the things to think about is what does that mean for your non-U.S. exposures? Most people will have that hedge in, like a hedged position. So it's to think about whether you want a hedged versus non-hedged position. That's one thing that clients are asking about. So should I be hedging my positions back to the US dollar or should I not be? So that's one thing to think about. And I think we can possibly continue to see sort of a range bound to a weaker dollar here. That's number one. And number two, it actually brings about quite exciting opportunities in EM perhaps. To the extent that a stronger dollar historically has been pretty bad for certain corners of the EM market. I think now, especially with rates pulling back a little bit, I think corners of EM, again, looking at active management and corners of EM can be exciting again.
I'm going to sneak in one more, actually.
Please do.
When we talk about not being worried about a recession right now, given the volatility that we've seen in the market, how worried are you about the possibility that we might not see a tax cut extension from Congress? And what would that do? Is that even a possibility that you're considering?
I think that that's not a possibility that the market's thinking about right now. I think the sequencing of when you got headlines around tariffs and immigrations, and obviously that came first, and the market still expects that there's going to be the tailwind coming from tax cuts later. I do think if that's something that at some point is completely discounted out, we probably could see some further volatility. I do think, this is again coming back to my point of adding hedges, adding diversifiers. This year is not going to be the 2024 year where you just have that one straight line up, macro narrative, the Fed is easing and growth is strong. This is going to be a lot of little micro stories that are going to add volatility. And I think that's where active management and adding all of these hedges really makes sense in a portfolio.
Gargi, it's great to see you in person,
especially.
especially. Thanks so much for coming in.
Absolutely,
Appreciate
thank
it.
you.